We have Nitin Panwad, who's the Group CFO at Vaibhav Global, joining us. Welcome, Mr. Panwad. Just want to quickly zoom in and check. We are expecting further rate cuts. We've already seen a 50 basis point rate cut coming in from the US Fed. We're seeing more rate cuts globally as well. You're export-oriented, export-facing. Talk us through how you're expecting demand to play out in this environment, maybe over the next 6 to 12 months.
Yeah, thank you. Yeah, thanks for asking the question and thanks for having me. Good morning to you and all the viewers. But the talking about more inflation scenario, so we are seeing that the sign of inflation pressure is easing out, and then Fed and the other major central banks are giving a signal of rate cuts. Some of them already done and some of them already doing. It's a good sign that the banks are now focusing on economic growth, so which will help us in sector like us in retail. But obviously, it is to evaluate that how the businesses and the consumers both will react and how long it will take to react that. But definitely, the rate cuts, the lower interest cost will obviously gives us a stimulus to the businesses to invest more, and also the consumers, as they will have more money in their pockets, so they will spend more in the mainly in retail sectors.
Given a mid-teens, sure. So you've given a mid-teens kind of growth guidance. Do you expect that to at all get better? Because US has been, it's been tough in terms of growth for you. Single digit is what you've done. Do you expect that to start to go to double digit maybe?
Yeah, but right now it is very hard to predict because the environment is pretty uncertain. This year's election cycle is also coming, and well, where the more eyeballs move to the news media from the entertainment media. But the kind of consistently offering the value proposition we have to the end consumers with the vertical integrated supply chain, so which is giving us a competitive edge compared to the direct competitors we have in the market. So it will help us in terms of gaining the market share, but we are keeping the guidance that we have given for the full financial year mid-teen growth, even with the tight scenario of election year and the still high interest rates in this financial year at least.
Bulk of that coming from Europe even now, you reckon? UK as well as maybe Germany as well, and some of the other European countries you're foraying into?
Yeah, so I think so part of the good growth is coming from existing businesses, but part of the growth is coming from the new acquisitions that we have done in one in UK and one in the US. Basically, the company is Dutch-based company but operates in US. So the part of the growth is coming from the existing businesses and the new businesses both, and we expect that the both will continue to grow and increase our market share, especially that the UK acquisition is panning out well. And then I think the last 9 months of acquisitions that the company is making the profit on direct cost basis, and we expect that in the next 3 months it will be profitable on the fully allocated cost basis, so which will give us a more the margin improvements.
Right. In terms of gross margins, what are you seeing? What's the trend with regard to both raw material as well as how is that playing out on your gross as well as your EBITDA margins?
Yeah. So in past quarter that we have reported in Q1, we have seen a pretty good improvement in gross margins, 500 basis points improvement in gross margin that we have reported, which is mainly coming from the improved product mix, product portfolio, and the higher revenue generation from digital segment, native digital, which I would say. So that has resulted 500 basis point improvement in past quarter, but we expect this financial year also to improve overall gross margin by 200 basis points with the improved product portfolio and pricing strategy that we have. Apart from that, some of the improvement in gross margin that we have invested in our content broadcasting cost, so which is mainly in line with our elevated expenditure in digital segment. It is part of the strategy that we have. We are getting more market share from digital side as we see the bigger TAM available out there. So normally digital spend in the short run cycle impact the impact the net margins, but once it's pan out and pay off, once we see more lifetime value and revenue generation growth in upcoming periods.
And this shift more, or rather your revenue shift towards the UK, a possible FTA with the UK, How does that change things for you, and how do you believe that the revenue mix will change as a result of that, if that were to happen? Of course, we're waiting more clarity on that.
Yeah, FTA will be good. Definitely, the export companies who is doing business in UK. But what we see that the benefit will be good amount of benefit in terms of duty, but we don't see it will be a substantial. But the benefit will be there around roughly average out 3 to 5% duty we pay for the goods import in UK, and that will help us. I think across our industry who are importing from India in terms of gross margins improvement.
Okay, and what about this shift from B2B to B2C is what you're doing? That shift is underway. You're going from 27% in terms of revenue mix in B2C to 50% maybe in the next year or two. Firstly, how quickly do you get there? And what are the levers you're going to use to get there? Because it's not easy to do that.
Yeah, sure. Let me correct you on this. It was not a B2B. I believe you were mentioning about digital and television share.
Yes.
Yeah. Yeah. So digital is continuously growing. Not only in terms of our multi-channel strategy, where we are moving our television traditional customers to more experienced on different digital platforms, not only just our proprietary website, but all mobile apps, smart TVs, OTT platforms that we are moving in, but also the native digital customers that we are acquiring through different social media platforms from Meta to Google. So there is a much higher market share available out there. And our investment that we are doing in past 1 year, that will pan out in upcoming period, and more lifetime value will generate from the same consumer, as we will have the multi-channel experience that we will give to the end consumers, while the normal B2C player will not have. We can move this customer not only just to give experience of our website, but also on television, OTT platform, mobile apps, smart TV apps in different platforms. So that in this area, it will help to improve our digital penetration all across the territories.
And is that better margin? Just a yes or a no?
Yes, definitely. The digital has a higher gross margins.
Got it. And therefore, where should your EBITDA margins move to? Can you clock double-digit plus by end of FY25? Is that something which is realistic to expect?
Yeah, so specific guidance we have given, but we expect that we will have a leverage in this FY25, and we will achieve in next 3 to 5 years our previous historically higher margin of 13 to 15%.
Right. And just with regard to product, what's the kind of new product pipeline you have? Just talk us through that.
Yeah. So as a traditional retail company, we are not fully dependent on a single product success. Every day, 50 to 100 new products we launch, which we give to the end consumers. And then consumers will see every time, every hour newness, and they keep buying on the different kind of products. In product portfolio, we have from fast fashion jewelry to beauty products to lifestyle products, from accessories to apparel, handbags, and different kind of categories. So all of the product portfolio bouquet, we have around 40,000 different SKUs throughout the year we offer to the end consumer. So we keep going on looking to consumer trend, consumer behavior with the kind of the current environment we are seeing in all across the world. But we keep on looking the consumer trend and behavior and offering the product accordingly.
Understood. Thank you so much, Mr. Panwad, for having this conversation with us, giving us that perspective, especially on export and possible levers with regard to rate cuts, which might come through, I mean, even more in a more accelerated fashion, likely going forward. Anyway, completely out of time on this edition of the SMID Show. From everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.